Hey, good morning, everyone. It's Edna here, and we are live for day 3 of our 5-day challenge. So, welcome back. If you don't mind, type in the chat box and let me know what you've been able to find so far. Were you able to find any money when you were going through the Find the Money worksheet yesterday? Or were you able to find some ways to make money for yourself on the 50 ways sheet, 50 ways to find some money? Like I said yesterday, the first time we did that sheet, it was kind of interesting. My husband wrote down on there that he would work at McDonald's as a part-time job, and we all laughed at him and said, "You would not." And he said, "I would if I needed to. I absolutely would." So you can come up with some pretty creative ways to make some money if you need to. You can sell a bike, you can sell a sled, you can sell a camper. Like, there's so many ways. You can do a freelance work. You can do some contract work on the side. There's so many different ways that you can do that. So some of the questions that I had yesterday that I'm going to cover off today is one person has asked me, what's your favorite part of real estate investing, and what would you like and what do you like about it? So one of our favorite parts of real estate investing is the passive income that we get. And another thing that is really big for us that we really like, because I'm a spender, I love spending money. And I very easily spend whatever I have in my bank account. So I love the fact of the mortgage pay down. You know, at this point in our careers, 10 years later, we've got over $25,000 a month in mortgage pay down alone. That's like somebody else putting $25,000 a month away for me each and every month. How cool is that? If someone would have told me that 10 years ago, that at some point in my life I would have somebody else putting that kind of money away for me every month, I wouldn't even have believed that it was possible. So when you're thinking of even just a straight $300,000 house, this is my worst case scenario that I talk to you about my investors. So let's say you buy a $300,000 house. And the reason I use this is because this number is stuck in my mind, because I know this right off the top of my head because I've given this scenario so many times. So let's say we buy a $300,000 house, and in 20 years, that house is still worth $300,000. Would you consider that a good investment? Most people would say no. But here's how I want you to think about it. So let's say again, so all our cash flow went to repairs and maintenance because we weren't able to pick good tenants, and or vacancy. So like I said, it starts out being worth 300. 20 years later, it's still only worth 300. We had to put 60,000 down payment in order to purchase that house. Now, let's say that we sell it in 20 years. Do you know what our profit is on that property? It's $240,000 that our tenants have effectively paid down our mortgage for. So again, that is our worst case scenario. So if that happened, that would be like somebody putting away $1,000 a month for you for 20 years. Where else can you get that? Most pension plans don't even put $1,000 a month away for you. Somebody else's or their money. They make you put away a certain portion of that too. So one house, people, can make a total difference in your life. That's $1,000 a month. And you can even take into account inflation, because rent will probably have went up over time if, say, you decide to keep that house instead of sell it. And what are your chances of a property still being worth only the same amount that you pay for it? I'm just going to ask you that. You figure that out. Good morning, Amanda. Good morning, Chandel. Good morning, Rob. How are you guys today? Nice to see you on here. I didn't have a struggle today. As a matter of fact, when I first opened my phone, there was something that came up that said my JV Secrets group, and I pushed post and I got right in immediately. So I don't know what my challenge was yesterday. I think Facebook fools around with me just to keep me on top of my toes. Anyway, and so some of the things that people are saying in the group is that they really want to work towards having the passive income. So let me know what you're learning out of this. Like, can you actually see that it's a possibility? You're going to get some clear examples today. I'm going to give you a real live example of a property we own, how we analyzed it, what it looked like when it came to us as an offer and stuff like that. So we're going to go through that today. What some of the students have answered, we asked out, what's your 1-year goal? Some is saying to learn as much as possible about obtaining multi-unit properties and to have an 8 to 12 unit apartment building under contract, or not under contract, ownership. So that's a great goal. And what is a 5-year goal? Well, and to have enough multifamily units to comfortably semi-retire with passive income. And you know, that was exactly what our goal was when we started. When we started, we wanted 50 doors so that we could get $5,000 a month in passive income. And we did it in 18 months, just so you know. So, and just so you know, you're not always going to see that cash in 18 months. It depends if you can get any refinancing, how much you negotiate up front. There's some different things that could happen in the meantime. But you could have yourself set up in 5 years to be making $3,000 to $5,000 a month in passive income. So think of the difference there. What are your other options? You know, you're going to learn how to buy real estate with other people's money. And I know I've had a lot of skepticism in the crowd. I've looked at the comments, and people have said, you know, I've paid a lot of money. I've joined other things. Everyone has the answer. Everyone has successful students. Well, you know what? I honestly believe that everyone has had successful students. Does that mean you're going to be a success following my plan? I can't guarantee it. You know why? It's because 99% of it is up to you. I can teach you everything that I know that's worked for me. That's all I can teach is what's worked for me. But if you don't do what I say, and it's not easy. It's a hard grind. You've got to get up every day with something in your mind that says, I can do this. If you keep telling yourself, I wasted another 5 days listening to this crap. I wasted $5,000 by taking this course. You know, we've never thought of it like that. We've always thought every course we've ever taken, we've learned something, we've gotten better. Have we got every single thing we ever needed to know from one course? No. We've spent a fortune on our classes. Like even the very first class we took, $27,000 US we paid. And when we took our award 18 months later for getting those 50 properties under management, there were 3,000 people at the convention, at Robert Kiyosaki's convention in Florida. Do you know that there were people there that had been involved in their classes for 3 years that hadn't done anything? I heard Robert Kiyosaki be called a scam. This is just a scam. I actually have seen it in a news flash. And I would get on there and I'd say, no, it's not a scam. This is awesome. Look what we did. So you know what? In reality, it is up to you. You can't say, oh, what I taught you didn't work. You have to do the work, and you have to do it even when it gets hard, because it does get hard at times. Do you think we just sat back and watched TV every night while we built our portfolio? Absolutely not. We were on the phone, we were making calls, we were getting disappointed, we were getting frustrated. There were times when we were thinking this doesn't work, and so we've been there. We've been in your shoes thinking this way, but we stopped thinking that way and we started just saying, you know what? We're going to do this until. This is the best wealth building strategy we know of, and we're going to do it until. So if the sooner you can adopt that attitude, the better off you're going to be. Okay, so what else do we have here? Okay, so one of the things that I talk about a lot in my 90 Day to 5K program is get as specific as possible on your vision, because for now your pain is going to push you because you want to make some money. You want to get past this hurdle in your life, but your vision has to eventually pull you. What is that vision? Do you want to be somebody who can get up on stage and talk to other people and teach them what you did? Do you want to be laying on a beach? Like, do you want to help your kids buy their first property 10, 15 years out from now? Like, the clearer you can have as a vision, the better off you can be. I had one student that sent me back his homework on the vision, and he said, I want to have my debts paid. Guess what? That is not a vision. That is not a vision. So if that's the only vision you can see, good luck. Good luck. You need a clearer vision of what you want your life to be. You need to be able to picture it in your mind. So maybe the goal is 50 doors, passive income in 5 years, and detail what that is. It's maybe 2 25-unit buildings, whatever, something like that. Get really detailed. Maybe it's 437 doors 10 years later. It doesn't matter. Get detailed. Some people are saying, I don't know how to get started. I'm afraid of messing up once I get started because of lack of experience. You know what? The best thing that we ever did, was partnering with somebody who already had some experience. Do you get 100% of the deal? No. Maybe you get 3% of the deal. Maybe you get 4% of the deal. That is your best learning opportunity. Just like writing up this offer that we're going to talk about today and getting it accepted is more than me talking to you for 3 months straight about writing the offer. If you actually write an offer and get it accepted, that's more than I can teach you. The experience is priceless. So get it done. Hey, good morning, Connie. Nice to see you on here. Good morning, Inger. Good morning, Jason. Got lots of people joining me. Good morning, Ken. Great to see you guys on here. Okay, so, and you know what? Don't be afraid of messing up. Whatever you focus on expands. So if you always are worried about what could go wrong, yeah, things are going to go wrong. Think about the stuff that could go right. You know, if we would have focused on the fact that, oh yeah, we could have lost all our money. Oh yeah, we didn't make a very good decision when we bought that condo. Oh yeah, we didn't, whatever. We didn't master every single strategy. We only mastered a couple strategies. We didn't master every strategy out there. I've yet to wholesale a deal. I've yet to do a fix and flip. It doesn't matter. Pick something that's going to work for you, and then just do it. Do one strategy till it works really well for you. And like I said, when you're worried too much about messing up, then that's what you're going to do. Keep focused. This is what I want to do. This is what I want. This is what I want. This is what I want. Keep telling yourself that every day. Every time a negative thought comes into your mind that says, I can't do this, it's meant for somebody else, let that go and focus again. I can get an apartment building. If two 20-year-old guys who've never even moved away from home can get a 12-unit apartment building, you can get an apartment building, okay? Some people look at me and go, oh yeah, but you're a financial advisor. You know what you're talking about. I didn't know anything about real estate, but look at my two 20-year-olds. They're amazing. So success stories, yes. Can I guarantee you success? Well, if you follow the system, you'll have success. It might take you longer than some of the other ones. Doesn't matter. Just don't give up on yourself. Best areas to buy in and have positive cash flow properties and good, reliable customers. You know what? We've got properties all throughout Saskatchewan. Most people looking at Saskatchewan across the world would think this tiny, dinky, linky little province with 1 million people, how can you put all your eggs in one basket? Well, you know what? We've got a lot of people living here. We've got most of our apartments full. Right now, the highest vacancy we've ever seen is in Saskatoon, and it's 10%. That still means we're 90% full. Let's focus on the 90%. Treat them as good as possible. They're going to stay. You have to think about your tenants as your customers. Each one of those customers could be paying you $8,000 to $12,000 to $20,000 a year. How many businesses out there can claim that from one customer? Treat them good. Treat them like the gold that they are. And how to buy in cash. Well, I'm going to show you how to analyze so you can buy in cash flowing properties. What you need to do is check out the industry. Check out what's going on in the economy. If you're an economy that's a one-hit wonder, it's a little tougher. Sometimes you're really high and sometimes you're really low and there's no middle of the road. One thing I really like about Regina is it's actually the capital city of the province. We've got a lot of government workers here. And so we're always going to have renters. That's the one thing I like about residential. Where are these people going to go if they don't live in your buildings? It's getting harder and harder for people to get mortgages on their own. That just means they have to be tenants longer and longer. You want to take good care of them. So we're finding our best areas to buy in Saskatchewan and Manitoba, but I know I have students right now buying in Chicago. I have students buying in Hamilton, Ontario. I have people buying in Edmonton, Calgary. We're taking possession of a office building in Calgary later this month. We just signed the documents today. And like there's opportunities everywhere. And some people, oh, I don't like small towns. Well, you know what? One of our best deals we ever did was in a town with 3,000 people. So think about that. You just need to know what's going on there. Get your boots on the ground or get somebody who's got their boots on the ground and check it out. Another question we had asked is, are there any parts of real estate investing that you're currently struggling with? And one person said, I have properties I have access to, but I have timing fears, like when's the best time to time the market? How to be sure the money will be there when I put myself out there and tie up the property? You know what? You'll never be 100% sure of anything. Do you know, even now when we tie up properties, I tied up one today, $5.5 million we're going to be paying for that. Do we know 100% where that money's coming from? No, but you can bet your dollar I'm going to start working on it. Is there a chance we won't close on it? Yes, there's always a chance you won't close on it. Does that mean you stop? No. Maybe you find something smaller. Maybe your first one is a small house worth $150,000. Build up your credibility. Maybe you can't start with an apartment building. Maybe you've ruined your credibility in the past so nobody trusts you or believes in you. Start with something small. Give up everything on the first one if you need to get that investor believing in you, in your credibility. Because you know what, we've had times where we've actually, we worked on a 24-unit apartment building for 3 years and we ended up with no dollars in our pocket over that unit. And our investors did really well. Well, guess what? I didn't make any money on that, but I still have those investors with me. And that's why I can say I've got 25 investors and $47 million worth of properties. Sometimes that happens. You have to decide that no matter what, you're going to take care of your investors. Okay? What's your favorite part of investing, and what would you like to take away from this 5-day challenge? We're getting a lot of the ability to actually build wealth for freedom and security for my family. That's why we did it. For resources to give and bless others. For a legacy for my family. For the respectable platform it can provide so I can reach people and make a difference in their lives and in this world. And you know what? That is a wonderful way. Because the more people, I can't remember if it's Brian Tracy that says this, but the more people that you help, the more money you'll make. And I don't even know if that's the exact verbiage, but if you set it as a goal that you want to help other people become real estate millionaires, they could be your investors or your students, then absolutely you've got a great thing going. Keep going after it. Will it always work out for you in the first year? No, not always. I see people. One of the fellows that I followed from the Rain Group, he bought, I think, a house, and then he never bought his first apartment building for 10 years. And now he's got, I don't know how many millions. I think it's like 300 million indoors. So he didn't give up, even though it was 10 years. And he's a very analytical person. So I think what he did is he overanalyzed for all those years till he finally decided to pull the trigger. Janelle says, love your integrity, Edna. Thank you, Janelle. You know what? I learned a long time ago that the first person I need to please is myself. And if I say something wrong, I hate that feeling that comes to my head. I like to be in integrity with myself and with everybody else at all times. It's just easier. You feel better. One of the things that I tell people living in integrity for yourself, if you tell yourself you're going to do something, do it. Because the more you disappoint yourself, then it's harder for you to bring in investors because you're just afraid of disappointing them. So start with not disappointing yourself. If you agree to do this 5-day challenge, then get up and get it done. You know what? That's the best thing you can do for yourself. Do something for yourself first. Okay. What's your 1-year goal? We had somebody say reach 4 wholesale deals a month and have 5 income properties. That's a great goal. What's your 5-year goal? 2 wholesale deals a week and 100 passive income properties. That's a great, great goal for 5 years. We were asking if people were able to sign on live every day. We got a lot of people saying no, they'd have to catch the replay, but didn't matter. They're committed to doing it anyway. So thanks for that. And then what else? One question we had is, how do you be sure the buyers or investors are really ready with their funds? You know what I do? Because we're actually working on a deal right now in Rocanville, two 12 units that we have under contract. Met with investor day before yesterday, and he said, okay, what do I do when I get the money? Because he's doing a line of credit equity from his home. I said, as soon as you get the check, take it to this lawyer and drop it off. You have to take your ID in because they want to make sure there's no money laundering. And as part of our due diligence, that's something we need is 3 months bank statements or the proof that it's coming from the equity out of your home. So that's what we do to lock them in. Okay, take your money to the lawyer. If they don't take the money to the lawyer, they lose out. And guess what? This happened. Tyler and Bailey, when they had their 12 unit, they were talking to all kinds of different investors. Everybody was interested, and they had to talk to their lawyer. They had to double check with their spouse. They had to get home equity line of credit, that sort of thing. Well, in the meantime, their first investor said, oh, we were hoping that you didn't raise the rest of the money. We wanted to be full partners with you. And they went, really? Well, it's too late. Then they talked to me and they said, is it too late? And I said, well, how much money do you have sitting at the lawyers? They said just their money, which was $150,000, I think. And I said, then if there's no other money sitting at the lawyers, it's free for all. First come, first serve. And I said, go back to your first investor and say, how soon can you get the funds down to the lawyer? And you know what? They said, we'll have them there tomorrow. And they did. And so now they are 40% partners on that property. So it's very important. And you know what? I said to them, I said, that's the best thing that could ever happen to you. Because now when people look at your deals, it's not like, well, I'm going to wait. I'm going to just wait. I'm going to get my lawyer to check. I'm going to check with my spouse. I'm going to see if I can get a line of credit. I'm going to see, because the deal could be gone. That's the best thing that could have happened to you, I told them. So now people realize, now, do you really lose out? No, we always have another deal. We got another deal going right now that those same people could get in on. So just know that could happen, and think of it that way. What's my best case scenario? And then go for it. It could happen. Your first investor could struggle with the first 100,000, and then after a while could decide, no, I want to put in the full 300. How interesting is that? Okay, so another thing, thank you for all your interactions. Love this, your questions and your feedback. I'm getting lots of amazing answers back and questions. If you haven't had a chance yet to submit your day 1 homework, please do it. We're still looking at it every day. We're getting through them. They're really helpful with us building our program because we want to answer your questions. So whatever questions you have, you're the people here, we're answering to you, whatever you can do. I can learn more about each and every one of you, where you're at, how I can help you specifically. So yesterday we discussed various ways to find money, and you were given your homework challenge to go through your worksheet and find the money from within your own network. So did you do the work? Did you find any money? If you found some, type it in here. You don't tell me the name, just tell me the amount you found. I'd love to see that. Eric says, I love your pink hair. Well, you know what? I have to laugh, and I have to tell you a little thing I found in the challenge group yesterday. There's a bunch of people saying, I'm in. And one person said, I'm not. She has Trump hair. And I start to laugh and I said, well, not every day. Every day I don't have Trump hair. I don't have Trump hair today. So I thought that was kind of funny. Yeah, my pink hair is kind of my trademark. So thanks very much for that, Eric. Even if some days it looks like Trump hair, that's funny. Anyway, tell us how much money you found. I'd love to know, because you know what? Sometimes your money is going to be found in the most unlikely of places, and there's something good about that. You know, like I said, the more people you can write down, and you know what? I still do it myself. I'm working on a $6 million deal right now, and be darned if I didn't get a text yesterday from somebody saying that they've got some foreigners wanting to come into Canada and they've got, I think, $20 million to work with. It happens. It absolutely happens. So just put it out there. Okay, so here's what we're going to cover today. What a real deal looks like. Places to search for properties. What to look for when you're searching your listings. Items to consider when you're doing your due diligence, and preparing your property summary. Your property executive summary is what you give to your investors. So let's start with what a deal looks like. We have sent this out in the email already, so check your emails, and then again, post your questions as you go through it. We also sent you out an offer to purchase because we want you to see what one actually looks like. So I want to go through that with you today, and I didn't get a chance to print it off, so I'm just going to go on my computer. So if you bring up your offer to purchase, let's look at that, because one of the things that I tell my students all the time is to, you know, always ask for a vendor take back, especially if you're dealing with apartment buildings. What a vendor take back is some seller financing. Now, if you're working on a building that say it's worth $2 million and you raise 15% of that from your seller, then that means you only have to come up with 10% from your investors. Now, why is that important? Well, this is why it's important. First of all, real estate investors, current real estate investors, are already predisposed to investing in real estate. They love real estate. Now, they might be going on to move on to a bigger deal, but they might be willing to leave some back before you just to get that deal done. Now, the other benefit of that is they get a little bit of cash flow while they're maybe working on their next deal. So there's ways to talk to them. There's a way to sell a vendor, because a vendor doesn't always realize why it would be a good idea to leave some money behind in their deal besides helping you buy it. There's benefits to them too. And I'll get into that a little bit more. But anyway, so on the offer to purchase, it's we, whoever your company is, or your personal name, whatever it is, called the buyer of, and then you put the property in there. And now I have to move my glasses to get that off. Hereby described, hereby offer to purchase from, and that's the seller, the following described property. And then you describe your property. And this is usually in the listing. You'd have your plan number, your lot number, your block number. Now, if it's not there, you can Google search that under your property assessments, and usually have access to that, and you can find out that too. So, and then put your dollar amount, write it in numbers and in words. So if you're whatever your purchase price is, say it's $2 million, write that. So the sale price of $2 million is meant to be paid as follows. So this is where you want to put down the deposit you want to make. Now, if you're dealing with a single family home or a duplex, you know, make it $1,000. It's not a big deal. They might ask for more. They might make it mandatory to be more. I always tell people I'm working on more than one deal at a time. I don't want to tie up all my funds. If you won't take $1,000, I'm not going to do your deal, or maybe I'll move it up to $5,000. Depends how bad I want the deal. With an apartment building, it might be higher. You might want to initially offer $10,000 on that $2 million deal. And the deposits by check. I don't give cash to anything. It's not even allowed nowadays. It's still in all the offers, but it's always by a check. And we actually get the check made to our lawyers or their lawyers, one of the two. We don't make it out to a personal name. Even if it's for sale by owner, the check should go to their lawyer or your lawyer. If they don't have a lawyer, make it out to your lawyer with the offer to purchase. Then below that, if you're going to assume a mortgage, which happens sometimes, if that you can assume a mortgage, then you write that in there in number B. Oops, I just got to see why I'm not bringing this up. And whatever the assumable mortgage is on there is what you're gonna put in there. So they'll tell you ahead of time if there's assumable mortgage that they need you to assume. And the reason why you might get an assumable mortgage is this actually happened to one of the students just recently in my 90-day to 5K program. They got a 24 unit under management or under contract. And the guy had a specific price they were asking because they had to have the mortgage assumed. They had refinanced at CMHC a year ago and signed up for a 10-year mortgage at 2.77%. So that's a great mortgage. They got it with CMHC, which means they only had to put 15% down. And the seller was only looking at 3% to make 3%. So really, our clients could get that building with 18% down as long as they assumed that mortgage. So it worked good. They put the assumable mortgage. They knew exactly what it was. They put that in the offer. And then below that, they would put the difference in the new mortgage. So in this case, it was they just needed to add a 3% to that. They were going to raise that through private money, though. They weren't even going to get a mortgage. They had asked for vendor financing. The vendor said no, but as it came back, it was actually almost as good as getting 15% vendor financing because they had CMHC financing, which is at the best 15% down, and so they only had to come up with 18%. A lot of times you have to come up with 25 or 30. So deals like that work, and then put down the balance of cash to be put out in when the conditions are removed. Then you'll usually agree to pay about a 3% interest if you happen to be late. If there's some overlap, don't go too high. Some people put 7, 8, 10%. No, it's if you're late, most of the time it's not your fault. It's something that happened at the lenders, because even if they tell you they're going to have the money there by the 28th, so it's closed on the 1st. Sometimes it just doesn't happen. So most of the time that's not your fault. And I just won't put 7% and go, no, 3% is all you're getting. That's, it's not my fault if something like that happens. And then put the transaction of purchase and sale shall be completed on and then whatever day. Now, generally with a house, you're going to have about a week to 3 weeks to get financing. You can always ask for 3. They don't always want to give it to you. And if you're competing against somebody else, they won't. But if it's something that's been listed for a long time, they will. That's where your best bargains are going to be anyway. And if it's an apartment building, you're looking at 90 to 120 days out. If you run across a realtor that tells you something different, they don't know what they're doing. They have never dealt with an apartment building. I've had a realtor say, oh no, you can't leave conditions for longer than a week or 2 weeks. I know you've never bought an apartment building. Yes, you can. 90 to 120 days. When we bought the 144 unit in La Ronge, Saskatchewan, it took us 10 months to close that deal. 10 months. So it happens lots. Most of these things are pretty standard on here. I'll let you read them. If you're including a fridge and stove or dryer, make sure you check off how many. If it's a house, there's 1 or 2. If it's an apartment building, could be 12 or 24. And owned by the seller. Make sure, because sometimes you get furnished units. You buy an apartment that has furnished units only to find out that all the furniture is leased and you just have to take over the lease. So be careful with that. Because some of that lease stuff is like 21% interest, so be careful. And it says if the offer is not accepted, the entire deposit and any other monies paid come back. Also realize that unless you remove conditions, you also get all your money back too. And then put down when the offer is open to acceptance. So say, for example, we usually give them 24 hours to accept our offer. I've actually stood on a step of a house in Regina here when we were buying houses. And my husband and I had got there first, and we went through the house, and while we were in there, somebody else showed up. So he must have made an appointment with the second person, which, by the way, is a very good strategy for a seller. And we went out on the step while the other guy was walking around the inside, and we said, okay, we're prepared to make an offer. And he said, okay, what is it? And we told him, and he says, I think we'd probably take that. Let me check with my wife after I go show this guy. And I said, no. Here's our offer, check with your wife now. So he looks at me and he goes, oh, okay. So he phones his wife, walks around the back of the truck, phones his wife, comes back, and he says, okay, I'll take your offer. I said, okay, here, sign here. And he signed it, and it was accepted before the guy in the house could even make him an offer. So you know what, that's kind of fun when you do stuff like that. I was kind of tickled and proud of myself when I did that. So you have that possibility to do that kind of stuff too. Like you can say, no, I want you to sign it right now before you even talk to the next guy. He has no idea what the next guy's going to offer. Or maybe he played me and it was his son walking through the house. Who knows? It doesn't matter. We were happy with what our offer was. We still own that house to this day, and we're still very happy with it, you know? Those are just some of the negotiation tactics that you can learn too. So what else do we have here? Times of the essence. They've got a warrant that what they say is true. Then you sign as the buyer. You get a witness, seller and buyer's signature, and then the last page is acceptance. So that's where your seller will accept your offer and get them to sign it right then and there, and then you're done. Okay, so that's going through the offer. Again, if you have more questions, because I know I went through it really fast, feel free to put it in the chat box, and I'll come back and I'll go through it with you. Okay, so I'm going to give you an example of a real deal that we bought. It was 3 properties ago. So we bought a 36 unit in Saskatoon in, I believe it was November 2015. Now, I'm going to kind of go through that deal. It's not the ones that your numbers in are on for the 123 Main Street, but it still works the same way. You can just plug your numbers in. All there's highlights for the ones where you plug it in, and then the rest just work automatically. So just know that too. So with Hillcrest, we got it actually came to us through a realtor. One that we had bought other properties through. The seller wanted to sell. He wasn't offering any vendor financing. We asked all those questions up front. But they go through a description of the property. And this is kind of what you're looking for when you get a description of the property. The lot measures 200 feet frontage by 140 feet deep. 2.5-story poured concrete apartment building with brick and stone veneer. 24 suites have balconies and air conditioners. Bitumen roof was installed in 2007. That means your roof's fairly new, right? New intercom system, new front glass door and side light installed in 2012. 36-unit apartment building purchased for $4 million. Appraised at $340,000 more than we paid for it, which was really cool. We had to come up with a down payment of $650,000, and the mortgage was $3.340 million. The rent was $35,525 a month, and the cash flow was $9,666 a month. With cash flow alone, we expected to pay back the entire $650,000 invested by our investors within 5 years. All principal investment is returned to the investors before we see any profit. And you know what? That is a really good selling feature when you're talking to people about dealing with you. Just say, you know, people will say, well, you know, why would I deal with you? You don't have any experience. And just say, this is how we do our deals. We build sweat equity. So we'll basically manage, run, work our butts off to make this property successful, because we don't get anything until you're fully paid back. And then when you're fully paid back, that's when our cash flow and our percentage cuts in. So that has worked so well for us over the years. Some people think we work way too hard for the first 5 years, but you know what? it's paid off, and we're willing to do it. So one of the things that that I hear from different people is, well, I need cash now. Well, then you know what? You have to change your strategy. And this is actually something we've changed, and I've really pushed my students to get recently, is raise more money and take an acquisition fee. Now, the reason you want to do that, see, for us when we started, it wasn't such a big deal because we had savings, we had really good incomes from our work already. We didn't need our day-to-day stuff covered right away. So we looked at taking a higher percentage of the building, and so that, you know, once our investors were paid off, well, then we would get 60% of everything, and they would get 40. So that was our standard business model. We took 60, they took 40, but we didn't take, or in most cases, we didn't take an acquisition fee. Sometimes we did. Now I'm telling my students, you know what? Take a lesser ownership if cash flow is an issue for you up front. You're the boss. It's your deal. You get to structure it however you want. Some investors are going to love the fact that they get a higher percentage of the deal. And won't care if you get a bit of an acquisition fee. I'm going to give you an example. So the very first apartment building that I raised money for was an 18-unit apartment building. And a couple I knew out of Saskatoon that I'd taken a lot of our classes with, we hadn't done anything with them yet, but we'd taken a lot of classes. And they brought me an 18-unit and they said, Edna, we're going to give you 75% ownership for raising the money for this building, or bringing the money yourself, whatever you want to do. And I said, well, you know what? I think I can raise the money for it. So what I did is I decided to keep 10% of the deal and give 65% to my investors. Because remember, this was my first apartment building. I brought in 3 investors at, I believe I had to raise 300 or 300,000, I think. And I took 10% of the deal. So that I looked, oh, and I did get an acquisition fee there. I think I got $12,000 or something like that. So I was happy, you know, but the second deal, it was a really big deal. The second deal we did was 144 units. I needed to raise $1.2 million. It took us 10 months to get everything done, including raising the capital. And what we did is, my partner and I were sitting on the bed in L'Orange because we'd been down there negotiating on the building and looking at it and all that kind of stuff. And we were talking the numbers, and I said, you know what? We're taking 60% ownership of this because we can have our investors paid back out of cash flow for sure in 4.5 years. We're not going to give 60% of this away. We're going to give 40% of it away, and we're going to each get 30. And then we weren't 100% sure how financing was going to work. So at the end, we had money extra sitting there. So we ended up both taking an acquisition fee of $75,000. And that was good for us because you know what? We won't see cash flow in that till it's refinanced. That was our choice. Nowadays, like I say, I'm telling my students, if you need cash today and it's a really good idea, don't take 60. Maybe you take 40. Maybe you take 35, depending on what you want for an acquisition fee, or if you want a little bit of a management fee every month, that sort of thing. Again, you got the gold. You get to determine what you're going to do. Okay. So with this one, cash flow was $9,666 a month. All investment capital returned to the investor before we see any profit. Principal payback to the investors would be $1,200 a month per 100,000 after the end of year 1. We always take the first year to optimize the building because you just don't know when you're taking over a new building. And I'm going to talk to you about the challenges we had with this one too. Because you just don't know what's going to happen when you take over a building. So our plan was to give them $1,200 a month, and we pay that out quarterly, not monthly, at the end of year 1, with balance coming back at the refinance between year 5 and 7. The investors will still maintain 40% ownership, and cash flow will go to 40%, or approximately $492 a month. So just to think that through. So until their principal's paid back, they get $1,200 a month. That's return of principal. It's not cash flow, it's return of principal. And then after, when they've got all their money out of the deal, they still make $492 a month. Isn't that sweet? And that's just cash flow. They also get their percentage ownership mortgage pay down, equity appreciation, forced appreciation. As rent increases go, they get their percentage on that too. So that's $492 based on today's dollars, not what the rent could be in 5 years. But we keep in mind too that the expenses are going to increase in 5 years. So Chandel says, what's a good amount of cash flow to look for initially? You know what I look for is that between cash flow, mortgage pay down, and equity appreciation, that we'll be able to have our investors pay back in 5 to 7 years. That's my main focus. And sometimes it's longer. This one that I was telling you in Saskatoon that the students got under contract, it was a 10-year assumable mortgage 9 years in. So they had to get investors that would commit to them for 9 years, because that's how long it was going to take before they could refinance. Now, there's sometimes a chance you can refinance early. I know with our L'Orange one, we had a 10-year mortgage on there. We refinanced at year 2.5 and got everybody's cash out for that. But we actually just put a mortgage in behind the first one with CMHC, so I think they kind of blended it or something. I'm not the one who looks after all the financing either, so sometimes I forget. Now, just to tell you a challenge that we had with this building so that you know how to handle the challenges. Okay, so we took possession of this building in October of 2015. Right around then, and like I said, we always take the first year to optimize the building. So we knew we had some work to do in that building. It was right on the cusp of an area in Saskatoon where we felt we could get it into a B level building, and it was a low C level building. So, but you know what? It was a nice looking building. We figured we could start attracting the better tenants. Now, what happened is Saskatoon went into their recession then, and vacancy rates went up. What else happened is we found out that the seller had filled the apartment with a bunch of really crappy tenants. Tenants that weren't paying their rent, tenants that cost us $20,000 last year in pest control. So guess what? We didn't have the cash flow. As a matter of fact, for the first time in our 10 years of investing, we had to go back to our investors and ask for a cash injection. So we call that a cash call. So that is something you have to be aware of too. So when you get your acquisition fees up front, it's not always wise to go out and just blow that money. You know, save it for stuff like this that could happen. So we actually ended up with 2 cash calls on that building. Now, just so you know, we own almost 24% of that. And each investor with $100,000 was around 5%. So when we had a $100,000 cash call, we had to put in $24,000 of that. The investor with $100,000 in there had to put in $5,000. So that's how it works. The more ownership you own, the more responsible you are for the cash call. And you can't get that all from your investors unless you're willing to pay them some kind of interest for doing it. So those are some things, those are some downsides, those are some things that could go wrong. Now, are we worried about that? No, we all still really love that building. We see the potential in it, but right now we're fighting vacancy every day. We're fighting to keep the I think we're 85% full in there. We're fighting to keep the ones that we have. So we've reduced some rents. We're renovating. We're doing whatever we can to make that a profitable investment. We know 5 to 7 years it's still going to look good. It's just not looking good right now. So keep that in the back of your mind. What's my worst case scenario? Worst case scenario, we bought a $4 million building, 20 years. We've done nothing but pay off the mortgage. That's still $3 million return on your $1 million investment. So keep that in the back of your mind. Because you know what? With real estate, it's not liquid. Sometimes it takes you longer to get your money out. And your investors have to be aware of that. You know what I tell them? You don't get the gravy without the potatoes. So you absolutely have to share the downsides with them. Because it could happen. We didn't know that the vacancy rate was going to go that high in Saskatoon. And you know what? And we're not sure how long it's going to last like that. We just do whatever we can to keep our expenses down and keep good tenants and look after our tenants and keep the building full. So there you got your first lesson on something that could really go wrong. That was our worst case. So what were the reasons to invest in this building? Well, initially it was because it was cash flow positive. We were $116,000 a year cash flow positive based on all our analyzed numbers that we had gotten. Now, for the challenge people out there now, you might have a property picked out. Post in the group if you do have. Let us know what you've got. Let us know what you're looking at and any questions you might have with it, because we can help you. If you don't have a property, in the email today, you would have got a list of places you can look. And then just use Google. Properties for sale. Like some people, it's just personal properties on their own Facebook page. I've seen that. So just keep watching. Let people know you're looking. I've had students that have found a good deal just because they talked to a neighbor about maybe investing with them. The neighbor was driving home from work one day and said, hey, I know you're looking at these kind of properties. This house is boarded up over there, or this house just had a for sale sign go up. Why don't you go check it out? You know, so sometimes you'll get people coming to you like that. Now, what to look for when you're searching? We like to recommend that you at least look for a double income property. That would be a duplex, up down duplex, side by side duplex, something where you can have two sets of rent coming in under one roof. Because if one is vacant, then at least the other's pretty much going to take care of your bills. So think of it that way. When you're looking at apartment buildings, this is why investors, the banks, and everybody consider apartment buildings a better investment, because sometimes you've got 12, 18, 24, 36 tenants under one roof. So if you've got 6 vacant out of 36 units, it's like no big deal, right? So you don't get 116,000, or you don't get 9,000 a month. Maybe you're only getting 3,000. You know, that sort of thing. That's what happens. Now, the reason, again, we avoid the single family, and you don't have to. There's been a lot of people that made a ton of money out of single family homes. But just to give you an idea, it is a little less risk if you go with a double. And under one roof, you know, you might pay $300,000 for a house with just a bungalow type house, but you could maybe buy a bi-level basement suite for $350,000. I'd buy the $350,000 all day long. You know what? That's only another, you know, few $1,000s that you need for the down payment. The more suites, the less you'll be affected by vacancies. Now, before putting your summary together and approaching an investor, be sure to stress test the property. This is something that you want to do. How high percentage could your vacancy rate go and you still break even or make money? Stress test at 5% interest rate, even though we're getting a lot lower right now. The banks are going to do that for you anyway. They're going to stress test to make sure that that it's still going to work at 5%. So do that. Items to include in your due diligence: vacancy and credit loss, potential rent income, potential rent increases, potential rent decreases, financing, operating expenses. Can you save money on any of the operating expenses? Reserves for replacement. For example, if you know, if it looks like the roof of your apartment building has to be replaced within the next year, then you know what? You have to raise enough capital to cover that, because you don't always get enough cash flow the first year to be able to do that roof. Sale price, cost of sale, acquisition costs, and discount rate. So acquisition costs could be would be your legal fees, appraisals, inspections, that sort of thing. And if you're one who wants to do an acquisition fee, it would also be your acquisition fee. So work all that out ahead of time. Minaj says, can someone work jointly with me, Buddy, or making offer for 1 or 2 prospective properties? Maybe detail that a little bit more, Minaj. I'm not sure people will know what you're talking about. Insurance is something that you watch for. Like I said yesterday, I had one of my students sent back something he was working a summary on, and his insurance was like, I think 197 or something. I can't remember exactly. And I went, on these buildings, when it's over 30 units, there's no way it's going to be 197 a month. I pay 147 for a duplex on some of my properties. So that's way too low. And we actually got burned on that because I went by the number that the person selling was insurance, and when I went to get the rate, mine was over double what theirs was. But it's because they get volume discounts, and at the time it was our second building, so we didn't get a volume discount. Now we do, but back then we didn't. So that's another thing. Get your actual insurance quote costs. Once you found your property, you need to be able to create and present your own summary of the real estate investment. The summary is an overview of your opportunity, and it needs to convince the reader that you've covered all the bases and that your due diligence shows this property as a sound and profitable investment. When raising money, you want to make sure you very, very carefully thought out the summary of your investment proposal and make sure you're addressing all of their chief concerns. Why should you get any portion of this deal when I'm putting in all the money is a big one. 25% return, that's too high risk for me. You know, you have to be really careful what you're saying to people. Just think to yourself, if I tell you you're going to get a 25% return on your money, instantly most people think high risk instantly. So you have to be really careful with that. Will you make 25%? Yeah, quite likely. But you have to be careful because people automatically assume there's a lot of risk there. So watch what you say. So now I'm just going to go through the deal analysis worksheet just to make sure. I'm just going to see what time it is because, oh my gosh, it's almost 11 o'clock. Can't wait to see the deals that you're working with. But if you bring up the investment and analysis sheet, I'm going to show you the few things that you really need to know right up front. The one is the offering price, and I always start by putting the numbers in at the asking price. Sorry, not the offering price, and then I change it up to what I think my offer is going to be. Figure out your mortgage interest rate. Right now, 4% is a good number to use. The last one that we got was actually 3.77, just so you know. But 4% is a good rate. 5% is even better. You want to go, I see on here it's 30 years. Depends how new your building is. If your building is older, you might want to go 20 or 25 years. Most of ours are 25 years, just so you know. You'll want to set aside $50 a month per unit per month for your repairs and maintenance schedule. So fill that amount in. Monthly insurance, again, like I said, get an actual quote because your number is going to be different than ours. Monthly utilities, that's something you're going to request from the seller, and they're going to give you a number initially, but in your due diligence period, you're going to ask for actuals. You're going to ask for the actual because you know what? All sellers are liars. They don't tell you the truth most of the time. And if they do, that's a bonus. So make sure you back up whatever they're telling you. Property management fee. Again, a lot of sellers leave that out because they say, oh, well, why wouldn't you just manage it yourself? That's what we did. Hey, and just to give you another example of a challenge we had with our Hillcrest property is in the pro forma, there was a live-in caretaker being paid $16,000 a year. Guess what? When we do our first year-end numbers, which we just got when we were going through our cash call here last month, I looked and I'm going, hey, how come our caretaker is getting paid $50,000? That is not in the pro forma. It says $16,000. What happened there? Because the partner said, well, we inherited the caretaker, and I go, well, they put on their pro forma he was earning $16,000. Why is he earning $50,000? And then they were paying him extra to do extra work. So believe me, we're looking at making some changes there. But you know, that's some of the things you need to do. You need to look, you need to adjust, and you need to make some changes. Right now, we're looking at a whole alarm system that would take care of having to have somebody in the building just living there making $50,000 a year plus a rent decrease. That's crazy. So you know what? I'm telling you experiences where we've actually learned. Now, do we say, oh my God, we're so terrible, we're so dumb, we did everything wrong? No, you know what? We didn't do everything wrong. Sometimes that happens. You know what? Sometimes that happens. Then you want to put your property taxes, that, and you can usually, again, they'll probably estimate, but you can get an actual in your due diligence. And you can also check the city website to make sure of that. Then in this one, it actually calculates what your revenue is based on your expenses, what percentage it is of revenue. And you know what? If it's in the 40-45% range, that's normal. If it's under that, yeah, you probably got to look at it closer. If you look at on the other side, it shows your revenue. That's what it is now, monthly, annually, what your expenses are, your mortgage payment, what your cash flow is, etc. And then that is automatic. It calculates what your mortgage pay down is every year. So if you look in year one below this on this $13 million building that we were working on, $237,000 a year in mortgage pay down. That is a big chunk of change. That's how we've been able to build our cash flow up, or not our cash flow, but our mortgage pay down up over the years. So that all works out automatically for you. And then you want to calculate, and this is what we use to figure out if we're going to be able to pay our investors back in the time period that we say. So property value after 5 years based on a 2% or property value inflation. In this case, we put 0.5%. Increase of rent 2%, but increase of expenses 2%. So we get a property value after 5 years. If we refinance at 75% again, gives us our original mortgage amount, gives you our equity from inflation and our equity from principal pay down. So it has the total equity you can get out of your property. Now keep in mind, we paid cash flow back for the last 5 years. So we don't owe them the full 600 or whatever it was, 25% down on this one. We don't owe them the whole thing because we would have paid them. So is it going to work? So total cash in the deal at this point is 0 for investors. Amount returned through cash flow year 2 to 5 is $683,000. So the amount needed to complete payout at end of year 5 is $683,000. So as you can see above, the total equity you can get out of the property is $646,000. It's going to take you a little bit longer than the 5 years, which is why we say 5 to 7. Okay, or you can refinance and give people most of their money back and just keep a little bit in there, whatever you want to do. So again, this is an awesome sheet. One of my students made this sheet after going through my 90-day to 5K program. I had one, but it wasn't as detailed. I'm not a detailed person, so I had to actually manually calculate the mortgage pay down, and he figured it out so it would be automatic. So we have Derek Jordan to thank for that. So if you ever see him in one of the groups, say hi and say thank you. He's very analytical and he gets all these numbers down perfect. So it's so very nice. So though you guys have learned a lot today. I hope you can run with that. I'm just going to see if there's anything else I need to just cover off. Oh, you know what? Again, I had somebody talk about, they've spent money on past education. They've spent a lot of money on past education and not got anywhere. And they want to know if they would have the same thing with me. Well, you know what? I can't guarantee your success because your success is based on what you do with the information I give you. I can't guarantee it. So most of the time when you're investing in a course, you're really investing the biggest portion into yourself. That's another reason why I don't let my programs go for cheap. Because if you don't believe enough in yourself that you'll actually do the work, if it's too cheap, you're not even going to do the work. You're going to put it on a shelf and it's going to be shelf help. You won't get anywhere. If it's a good chunk of change and it actually stretches you and hurts you a little bit, then you know I got to take and I got to do something with this. That was our attitude when we spent $27,000 US when we took Robert Kiyosaki's. We were not going to be one of those ones who wasted our money. So you decide, am I going to waste my money? Well, you know what, like I said, if you take what I teach, there are many students that have done really, really well. Can I guarantee you'll do well? Have no clue because I don't know you. I can hold your hand, I can help you, but if you've got no belief up here at all, going to be really tough. Also, another reason why I focus really a lot on mindset. I actually am bringing out a mindset class very soon in April, and which is going to be a 12-week program as well, because I think a lot of people are held back by their mindset. And maybe that's where you start, is on your mindset before you ever buy a real estate investing course. Because if you got to work on this first, it might be the best thing you ever did. Okay, so make sure you post things in the group. You'll get feedback from many people in there, part of my paid training, and actually have deals without any of their own money. So yes, it's working. And tomorrow we're going to discuss preparing and presenting the perfect pitch for your investors. Trust yourself, do the work, and don't make it more complicated than it has to be. You don't need to know everything to make an offer. All you need to know is the price. That's it. You can make an offer based on the price. Your due diligence will come after. Minaj is asking, what's a good price in Regina for 1 bedroom or 2 bedroom a door nowadays? You know what? We're paying roughly per door. Let me tell you, we just bought one. You know what? We just bought one in Regina in July. Paid $105 a door. Now, most of those were 1 bedroom. So $105 for 1 bedrooms, probably looking at closer to $113, $115 a door for 2 bedrooms. Now, that's rentable space. You can maybe pick it up less if you got a whole pile of work to do on it. But you know what? That's another thing. I actually love this about apartment buildings is, you don't often get a huge bargains on them because people know what the long-term investment's like in it, and they're willing to pay a decent price for it. So if it's a question of whether you're saving $2,000 a door, just think instead of how can I make that money back, as opposed to worrying so much about negotiating that. Same with the house. I've seen people lose a deal over $5,000. Well, do you know what $5,000 is going to be over the next 10 years? Nothing. That's going to be dinners out for a few years. That's it. Don't lose a deal over $5,000. It's absolutely ludicrous. So again, pull the trigger. Let's get you a property under contract this week. If you have any questions, reach out to me. I'm going to be looking at the homework, so I am excited about doing that. And we'll see you tomorrow, same time, same place. Thanks, everyone. And by the way, thank you all so very much for sharing the video. I noticed quite a few of you have done that. I really appreciate it. Thanks again. Talk to you soon.